Today, I want to talk about how Fidelity has been showing short interest of over 200% in AMC for nearly a week now, and how prior to the conversion, some brokers were showing APE at over $400 per share. I also want to talk about how, back in 2009, Virtu was actually against illegal synthetic shorting. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, Simulation Ape Nation tweeted saying Fidelity currently has AMC with a short interest of 257% as of this morning. No glitch, no Photoshop. And he said, hear me out. Maybe, just maybe, the self-reported data we're given is way off and not accurate at all. As I've said before, self-reported data is submitted to FINRA, but FINRA doesn't even check the data is accurate. They don't even check to make sure all firms have submitted that data because it's a self-regulatory organisation. They let these hedge funds regulate themselves and submit whatever data they believe is accurate. On top of that, tons of firms are receiving fines all of the time for incorrect short reporting data or just incorrect data being reported flat out. And therefore it's likely the short interest on AMC is not 40%. Maybe it's 257%, maybe it's even higher. This was obviously something I touched on in my video Friday, but back on Friday I couldn't find any screenshots to actually support that number. But this screenshot was posted yesterday on the 27th of August, showing a short interest of 257%. And it's not just a one-off data glitch, because this short interest percentage has actually been changing on Fidelity over the last few days. As a prime example, this screenshot of AMC is showing a short interest of 235%. And therefore it seems that short interest percentage is varying between 235 and 257%. And it's not just a pre-conversion, post-conversion mistake, because we know the shares on loan for AMC pre-conversion was around 40%. If it was just a pre-post-conversion mistake, it should be showing that short interest shares on loan at around 400%, not 257%. On top of that, Lou vs Wall Street also tweeted this screenshot showing APE with a $409 billion market cap. Obviously a $409 billion market cap divided by the number of shares in the APE float, which was around 1 billion shares, gives you APE at over $409 per share. And again, the craziest thing about this screenshot is it's actually showing a float for APE of 9.3 trillion shares. Again, we know full well there was only around 1 billion APE shares, or 900 million for that matter, so a 9.3 trillion share float is absolute insanity. This is obviously showing and proving exactly what I said, and that's that the APE conversion and AMC settlement would be an absolute mess. We know there's brokers out there that have or haven't processed the APE conversion, and we know there's brokers out there that delivered the AMC settlement early. Now, the problem with delivering that settlement early is that those shares didn't even exist to be delivered. So again, it just proves exactly what I said, which is the conversion, reverse split and settlement would be and is an absolute mess. You can also currently get a guaranteed free share of Tesla, a $50 cash reward, and up to 15 free shares on top of that, which you could always use to buy more shares of AMC or of GameStop. All you have to do is sign up to Mumu using the link in the description below and make the required qualifying temporary deposit. Signing up to Mumu is easy and it's free, it just requires that temporary deposit, and it's a really great way to help support my channel and to help support me as well. On top of that, Mumu is very easy to use. They've got tons of technical indicators and advanced charting tools and their own options trading platform. Now, Cat Striker tweeted saying 6.9 million settlement shares are being issued to shareholders. Divide that by the 3.8 million retail investors as confirmed by AMC's 10K is 1.8 settlement shares per person. Or multiplying that by 7.5, or taking the float of 51.6 million shares and dividing it by 3.8 million retail investors is 13.5 shares of AMC post-split. Now, I don't know about you, but as Kat is saying, she's definitely getting more than 1.8 settlement shares of AMC, or holds more than 13.5 AMC shares. Again, 13.5 shares post-split is all we need to hold per person to hold the entire float one time over. And similarly to me, I'm sure many of you hold way more than 13.5 shares, holding the float multiple times over. And now I also wanted to talk about how back in 2009, Virtu Financial was actually against illegal synthetic shorting. Now, many of you will remember the letter Ken Griffin of Citadel sent to the SEC back in 2004, voicing his displeasure on payment for order flow. Wall Street Apes tweeted saying everyone remembers those excerpts are from a letter that Ken Griffin, Citadel Securities, sent to the SEC asking them to ban payment for order flow. He said when it wasn't benefiting Ken, he wanted payment for order flow banned for the obvious conflicts of interest and the obvious reasons, but now he uses it to rob the world. And that is the exact same with Virtu and with Citadel being against illegal synthetic shorting, but now using it to rob retail investors. Crystal Ball tweeted saying from 2009, Virtu was commending the SEC for fighting naked shorting and synthetic shorts, and for addressing failed to delivers. Now, I actually found the letter sent from Virtu Financial LLC to Miss Murphy at the SEC. They said Virtu Financial LLC applauds the SEC for its careful and thorough review of the entire area of short sale regulations. Virtu commends the Commission in exhausting its independent agency obligations to find the proper application of short sale regulations with this goal in mind. Now, Virtu actually left some comments and suggestions for suggested SEC rulings that were coming in back in 2009. They said Virtu commends the Commission for its success in curbing naked short selling through implementation of Temporary Rule 203T and Permanent Rule 203, which are designed to restrict fails to deliver. They also supported the SEC on the creation of the uptick rule, which theoretically suspends short selling on a stock that's fallen by a certain percentage, especially when the stock is falling more. And even said they should implement circuit breakers or trading halts when a stock price is falling. And also believe the SEC deserves a great deal of praise for acting quickly during the financial crisis in its adoption of Temporary Rule 204T of Regulation SHO. They also commended the SEC for tackling the number of FTDs that were being seen each and every day. Obviously, I'll leave this letter linked in the description below so you can give it a read for yourself, but it's crazy how their story changes now the shoe is on the other foot. I've actually got two separate theories about this. Let's start with theory 1. Back in 2009, Virtu was not engaging in illegal synthetic short selling and therefore was obliging and congratulating the SEC for tackling synthetic shorts. Obviously now, nearly 15 years later, Virtu is engaging in synthetic short selling and obviously doesn't want the SEC to do anything about it anymore and continues breaking the law. Obviously, when they're losing money to synthetic shorts, they hate it. But when they're making money from synthetic shorts, they absolutely love it. Again, it's crazy how their opinion has changed and how they love being infinite liquidity fairies now that they're actually making money from it instead of losing money. Now, my second theory is this letter to the SEC was actually a ruse, similar to Bernie Madoff's ultimate plan. So Bernie Madoff of Madoff Securities run a stock brokerage and an asset management business. But on top of that, Bernie Madoff was also chairman of the Nasdaq Stock Exchange. Back then, Bernie Madoff would have been writing a number of letters to the SEC congratulating them on what a great job they're doing of regulating the stock exchanges and regulating the financial markets. He'd be saying, from my position as chairman of the Nasdaq, I see this stock exchange operating perfectly. You, the SEC, are doing a great job. Now, being the SEC, they would have never looked into Bernie Madoff being the chairman of the Nasdaq and running a stock brokerage and an asset management business. If he's the chairman of the Nasdaq and he's congratulating us as the SEC for doing such a great job, surely Bernie Madoff can't be doing anything wrong at all. Bernie Madoff effectively lulled the SEC and the regulators into a full sense of security. He had a position of power as chairman of the Nasdaq and was seen as somebody that is responsible and couldn't possibly do anything bad. And that could be effectively exactly what Virtu was trying to make out as well. They were telling the SEC great job on finding those pesky short sellers and a great job at stopping illegal synthetic shorting. All the while they were doing that illegal synthetic shorting and they were that very pesky short seller themselves, they were just congratulating the SEC on looking elsewhere. And because they were congratulating the SEC would have never thought to look in their direction. And still hasn't. Market makers like Virtu and Citadel have done such a good job at getting on the good side of the regulators would never think of looking in their direction, even though Citadel and Virtu themselves are running the largest criminal organisations since Bernie Madoff. But obviously let me know what you think. Do you think back in 2009 Virtu wasn't synthetically shorting stocks? Or do you think they were doing it the entire time and just trying to convince the SEC to look the other way? And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.